Okay, let's unpack this. We are diving deep today into the Q3 2025 earnings call for Rekor Systems. That's R-E-K-R.
Right.
This is a company that's been promising a pretty fundamental pivot. And this quarter, the one ending September 30th, was, well, it was supposed to be the proof.
It really was. And our mission here is to dig into those results. We're not just looking at the headlines, but the strategic signals behind their big pivot to a data as a service model.
Or DaaS, as they call it.
Exactly. This is the story of them trying to move from selling, hardware boxes to selling sticky, high-margin software subscriptions. And Q3 was the big test.
So let's start with that immediate snapshot. Management didn't mince words. They called it the strongest performance in Rekor's history.
And the numbers seem to back that up. They hit a record quarterly revenue of $14.2 million.
Which was huge. It blew past the consensus estimates of, $12.5 million? That's a 35% jump year over year.
The top line number is great, but what really got the market's attention, I think, was the cost discipline. I mean, yes, they still posted a GAAP EPS loss.
But it was a much smaller loss.
A much smaller loss. It came in at -3 cents, which beat the street's -5-cent consensus by a full 40%. It shows that the revenue growth is finally starting to flow through the P&L more efficiently.
Okay, so if the GAAP numbers are better, the adjusted EBITDA numbers, they tell a whole different story. This was the metric everyone was watching, right? To see if the operations are actually getting healthy.
Absolutely. And this is where it gets dramatic. The adjusted EBITDA loss, it narrowed to just under $1.5 million.
Yeah. So put that into context for us.
Well, it's an 84% improvement compared to the same quarter last year when the loss was around $9.5 million.
Wow.
That kind of reduction is the clearest signal yet that their operating model is finally hitting scale. The fixed costs are getting absorbed by recurring revenue. That's operational leverage in action.
And it was the best adjusted EBITDA performance in the company's history.
That's right.
And the market, despite that pretty steep drop leading into the call, it seemed to validate the results, didn't it?
It did, but cautiously. Shares bounced back about 4.9% the next day. So not an explosion, but a sort of quiet consensus that, this operational leverage story is finally becoming real.
So let's dig into the financial engine behind all this. That performance obviously didn't just happen. The big story here seems to be all about the margins.
It's a massive shift in the revenue mix. The adjusted gross margin expanded to 63.4%.
Okay, for you, the listener, who maybe doesn't track basis points every day, that's a staggering 1,940 basis point increase from 44% just a year ago.
It really is. It means for every new dollar of revenue, they're keeping almost 20 cents more in profit than they were last year.
That's a fundamental change. But why? What's driving that?
It's the DaaS model finally paying off. It's that simple. You're seeing a much higher proportion of high-margin software and data subscriptions versus the old lower-margin hardware sales.
Because the cost of serving one more software customer is basically zero.
Pretty much. They've successfully shifted their clients from a CapEx model to an OpEx model while shifting their own revenue to that beautiful high-margin recurring income.
But I have to ask the skeptical question here. How sustainable is a 63% margin? I mean, these huge contracts must require some initial hardware rollout, right? Like cameras and things.
That's a critical question, and management talked about it. Their strategy is to minimize that hardware part. Yes, there's an initial deployment, but they structure the deals so that cost is either absorbed upfront by the agency or it's just a tiny part of the total contract value.
So it doesn't drag the blended margin down over the long term.
Exactly, and you see that thesis supported by the drop in operating expenses too.
Right. They fell 26% sequentially and 20% year over year. So it's not just margin magic. It's real cost cutting.
That efficiency is why the GAAP net loss narrowed by 67%. And all of it validates the shift. The recurring revenue, the lifeblood of this model, grew 18% year over year. That's the foundation.
Okay, so let's just shift from efficiency to the strategic engine. You can have great margins, but you need to land those big, durable contracts.
And they landed some major ones this quarter. The momentum is undeniable.
And nothing bigger than the Georgia Department of Transportation contract. I mean, this feels like the statewide validation the market has been waiting for.
This is the behemoth, yes. It's their largest contract ever. It's an up to 8-year DaaS deal with a minimum value of $50 million.
But the real kicker is the potential to go beyond that, right?
Oh, absolutely. Management thinks it could exceed $100 million because the deal uses a cooperative purchasing structure.
Okay, let's define that for the listener because that term is really crucial for understanding the upside here. What does that actually mean?
It means that after the Georgia DOT went through the long, multi-year process to vet Rekor's tech, the final contract has pre-negotiated terms that other jurisdictions can just piggyback on.
So like counties, cities, other agencies?
Exactly. They don't have to start the whole tedious RFP process from scratch. It's like a fast lane for Rekor to onboard more customers across the state, which is how you get from 50 million to a potential 100 million plus.
That dramatically de-risks their sales funnel. And we also saw more success in places like South Carolina with their virtual weigh station program.
That program is just a perfect real-world example of their value. It led to an initial $1 million order with room to grow.
Because it works.
Because it works. Management highlighted that this AI program achieved nearly 100% accuracy in targeting overweight trucks. Think about what that means for a state losing tax revenue and repairing roads. It's an immediate, undeniable financial return.
And all this confirms the pivot is working. Their platforms, Rekor Discover and Rekor Command, are getting real traction.
Right. 3 more states adopted the Discover platform in Q3, but here's the ultimate proof point for the whole DevOps thesis.
What's that?
Government RFPs are now increasingly being written around Rekor's integrated data stack. Agencies don't just want a camera anymore. They want the cloud-based data, the AI insights, without the headache of managing the hardware. Rekor pioneered the model, and now the government is catching up.
Okay, let's turn to a couple of curveballs, starting with a big one. The CFO transition. A CFO resigning right as the company hits a critical pivot is always going to raise some eyebrows.
It absolutely does. Eyal resigned effective November 17th. But to their credit, management got ahead of it. They were very clear on the call that this was not due to any disagreement over accounting or financial reporting.
And that kind of transparency is key.
It is. And the replacement also points to stability. The incoming CFO is Joseph Nalepa, who's been the corporate controller for over 6 years.
So he knows the business inside and out.
Precisely. You get that institutional knowledge and continuity, which is exactly what you need when you're managing this kind of transition with complex government contracts.
And at the same time, they're innovating, looking beyond just roadways. They announced a really interesting new vertical, deepfake-detection.
This is a really shrewd move. Rekor Labs is building a deepfake-detection product suite, and it leverages their core computer vision expertise perfectly.
Because they've spent years training algorithms to analyze real-time video.
Exactly. To identify vehicles, read plates. So applying that same core skill to verifying the authenticity of media for commercial and government clients is just a natural, high-margin next step.
Commercial launch for that is slated for around 2026. This adds a whole new AI risk vertical.
It does, and management said they were looking at this kind of video analysis long before deepfakes were a huge public concern.
Yep.
It's a smart way to diversify into a premium market.
So looking ahead, the guidance seems to back all this up.
Yeah, internal forecasts are pointing to about $14.7 million in revenue for Q4, so continued growth. And they're looking at Europe and other commercial sectors for 2026.
So if we pull all of this together, the margins, the contracts, the innovation, and put it into the broader investor context, what's the big picture?
The big picture is that their execution is lining up perfectly with the sector's growth. I mean, the smart mobility niche is projected to balloon from about $52 billion today to over $340 billion by 2035.
And the Georgia and Texas wins give them a real first-mover advantage.
It solidifies it. They're locking down these long-term, sticky infrastructure contracts in a massive expanding market.
But it's still a small-cap company. And there are some big financial risks that still divide the market, which explains all the volatility.
Right. For all the progress, they're still GAAP net loss-making. And critically, the short interest is stubbornly high. It's near 12 million shares and was actually rising before this call.
So the short sellers are betting they'll run out of cash and have to dilute shareholders again, like they did earlier in 2025.
That's the thesis. It's rooted in historical dilution and skepticism about their path to consistent profit. The Q3 print definitely weakens that case, but until that GAAP loss is gone, execution risks and the threat of dilution are going to keep those shorts in place.
Okay, we've covered the numbers, the strategy, the risks. It is now time for our high conviction segment. And remember, this is analysis, not advice. But if we were pitching this turnaround, what's the outrageous but plausible trade idea here?
The thesis is all about the short squeeze dynamic. The market is, I think, mispricing how fast the operational leverage is kicking in. Skeptics are still too focused on past losses and dilution.
You've got 12 million shares short. That's a huge overhang.
It is, but the financial reality on the ground is changing faster than they're anticipating.
So you're betting on a forced cover, fueled by guaranteed revenue.
Precisely. The catalyst is that operational leverage forces the shorts to cover their position. You have a record 63% margin and a guaranteed revenue floor from the Georgia contract, which is already billing in Q4. Adjusted EBITDA profitability is now clearly in sight. That's what triggers a squeeze.
But what's the counter to the dilution risk that the shorts are so focused on?
Management confirmed they're working on non-dilutive financing, specifically something called a revenue sharing note.
Okay, explain that.
It's an instrument where they get capital now, but instead of issuing new stock, they agree to pay the lenders back with a percentage of their future recurring revenue. If they pull that off, the core of the short thesis dilution just evaporates.
And the stock would likely surge.
Instantly.
Thanks.
So the pitch is this. You initiate a long position. You're targeting a move driven by the next quarter's results and, crucially, any announcement of that successful non-dilutive financing.
And the price target.
You target the stock's recent high range from October, fueled by shorts panicking to cover as their dilution thesis fails right as profitability hits. The execution risk is already priced in, the operational leverage is not.
The leverage and the financing are the twin catalysts.
That's the thesis.
What a quarter. To recap for you, the listener, Rekor delivered record revenue, saw massive margin expansion from their DaaS shift, and landed a huge statewide contract in Georgia. Add in the cost control and the new deepfake vertical, and it really does look like a durable operational turnaround.
Which leaves a really important question for you to think about. How quickly does the market reward a small-cap software business that validates a multi-million-dollar DaaS model, especially once it solves its financing risks? Is that $340 billion smart mobility market big enough to absorb the current risks? Or are those 12 million short shares about to get a very rapid, very painful wake-up call?
Fantastic analysis. We appreciate you diving deep with us today.